morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, over the past few weeks, we've been reviewing how equity markets would have fared in the first 6 months of 2025. But of course, there's a sometimes overlooked but equally attractive segment of the market for fixed income investors. Of course, we're talking about fixed income markets. And let's take a look at what would have taken place over those first 6 months in terms of development, evolution, and changes in this particular segment of the investment market and what investors would have fared with and what they can expect in the coming months ahead. So turning firstly to the local side of things, well, when we take a look at the government of the Republic of Trinidad and Tobago got Trinidad and got yield curve, we can see that there was some notable shifts, although albeit to a moderated extent. We can see that over the first 6 months of the year, there was a slight shift upward across all tenors of the Trinidad and Tobago yield curve, with the most pronounced shift taking place on that one-year segment, with one-year got yields estimated to be offering a 4.14% yield, up just around 20 basis points from the one-year point in time. Less pronounced shifts across the longer tenors of the curve, with 5-year up just about 10 basis points, as well as at the 10-year point just up about 15 basis points. But generally, there was a modest increase in yields across all tenors of the Trinidad and Tobago yield curve, as can be observed here. Some factors driving that, well, several factors, in fact. One, moderating inflation, as well as excess liquidity, which we'll touch on in a bit, as well as active got issuance or got bond issuance, of course, with introduction of new debt being one of the primary measures in which the government would be able to utilize in meeting that fiscal deficit or a successive fiscal deficit over the past few years. Now, when we take a look at average annual excess reserves over the past, or how that has trended over the past couple of years, we can see that there was a slight decrease over the 2022 to 2024 period, with excess reserves falling from about 8.1 billion on average in 2021 to just around 5.5 to 6 billion between 2022 to 2024. That was met with an eventual cut in the primary reserve requirement ratio from 14 to 10%. That is how much how much cents of each dollar banks receiving a deposit would have to leave with the central bank. That would have been cut from 14 to 10%. And subsequently, we have seen an increase or recovery in those excess reserves, increasing as at May 2025 to just about $6.4 billion. What does that mean? Well, that means there is ample liquidity or increased liquidity available within the financial system. Or from a credit rating perspective, there has not been much change thus far. Since 2020, the S&P has continued to rate Trinidad and Tobago at its investment grade status of BBB-. Moody's has cut the rating from Ba1 to Ba2, so outside of investment grade, in fact, known as speculative grade since 2020 as well. There has been that 1 to 2 notch rating differential, and of course, it will be interesting to see what the next rating review brings up in terms of S&P and Moody's with respect to Trinidad and Tobago, given certain headwinds to financial performance and economic performance over the past few years and expected in the near to medium term. So overall, in terms of a local fixed income outlook, what investors can expect would be range-bound inflation, which remains more likely than less likely. Elevated interest rates, as we can see that those, the yield curve would have shifted up modestly over the first 6 months of the year. We also see ample liquidity being a trend going into the second half of the year, as well as continued got issuance, perhaps making some of those bonds over the counter and hopefully exchange traded also more accessible to individual as well as institutional investors. Now, turning quickly to the U.S. side of things, and for U.S. interest rates, again, still remains a fairly rewarding and attractive investment environment for fixed income investors. When we take a look at trends within the U.S. market and the U.S. government yield curve, we can see that there was somewhat of a less traditional shift in yields, with yields on average at the shorter tenors at least coming down, 1 year coming down from 4.16% to 4.12%, so a very small 4 basis point shift there. At the 5-year marker, a much more pronounced shift, falling from 4.4% to 4.05%, with a 10 odd basis point shift at the 10-year marker from 4.58 to 4.5%, and at the much longer term in terms of 30-year treasuries, there was a shift upward of almost 21 or 22 odd percent, basis point rather, from 4.78 to 5.01%. Now, in terms of projections for short-term interest rates, we can see that the federal or consensus estimates of where the Fed benchmark rate would be, would at the end of this year would actually indicate a roughly 225 basis point cuts from 4.5 to a target rate of 4%, which suggests that markets may be getting ready for continued decreases in interest rates, at least across U.S. markets, and with the U.S. benchmark yield, of course, peaking at around 5.5% after significantly increasing from 0.25% in December 2021. Of course, with the Russia-Ukraine war, supply chain challenges, and other factors, those rates have remained elevated. And while inflation is moderating in the U.S. to some extent, U.S. interest rates remain elevated for the time being. How has that impacted what investors can expect in terms of regional US dollar bond issues? Well, regional US dollar bond issues, those yields remain relatively range bound for the time being. For example, we take a look at Trinidad and Tobago's 6.5% 2034 US dollar denominated bond that is currently trading at a yield of around 6.6%, which is pretty much in the middle of its 6-month range of the 6.2% at the lower end and 7.1% at the higher end. 2-year treasuries, for example, trading at around 3.9% with a low of 3.6 and 4.4. So if we take a look right across the board, we can see that most of these bonds have been trading or are trading, in fact, at the middle or maybe perhaps a little bit closer to the lower end of their 6-month highs and lows. So overall, for international fixed income, when you take a look at the outlook, we can see that moderating inflation is expected to be one of those trends as we move later on into the year, with the likelihood of declining U.S. interest rates increasing, especially as we get towards the back end of 2025. Bond market stabilization and stable credit ratings and quality remain question marks to some extent. With pronounced interest rate changes, there is usually some degree of volatility. And we've seen that in terms of the fairly wide trading ranges from a yield perspective for some of those regional US dollar bond issues, which we just spoke about. So overall, is it an attractive investment environment for fixed income investors? Well, you can say so, certainly compared to the past few years. In fact, on the shorter term end, in the TT dollar space, reports would offer investors around 3.25%, moving out to longer tenors. Of course, in the USD space, that starts at about 3.5%. For income funds in the TT space, you can, with daily access and liquidity, earn at least 2% or thereabouts, while income funds would start off in the USD space at about 1.8%. For longer term bond issues in the GOT bond space, you can, over 3 years, of course, earn a yield of around 4%, with sovereign bonds offering pretty much the same sort of opportunity. And in the corporate bond space, again, depending on credit quality, of course, you can start earning for 3 years and moving outward at least 4.5%, both in the TT and US dollar space. So that's it for this week's edition. For more information, you can give us a call at 2BORS or 226-8773. Email us at info@borsfinancial.com. And of course, you can check out our website at borsinvestment.com, where all of our research is absolutely free. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.